Hi, Steve Van Metre here, and welcome to your Monday Night Premiere. We take about 15 minutes every Monday and Wednesday night, trying to make sense of markets that really don't make a whole lot of sense. As promised, this will be an expanded Monday night video. We will not have a video on Wednesday, and we'll be back Friday. Now, for those of you who know, I was off last week, a very rare occasion, so I only take a week off about every 3 years, and yes, I'm not joking about that. And while I had really good intentions to produce videos and upload them, and I actually did produce one, there was one thing I could not anticipate. And for those of you who work in the IT industry or used to be IT, then you know, because I used to be in the industry too, you go over-prepared. But there was one thing, if you can guess, that I could not anticipate. And that was the Wi-Fi being throttled to the websites I needed to go to upload videos. So it was just not, I couldn't even access the page. So they blocked it or throttled it to the point where it just wasn't going to happen. So we did learn a lot last week in terms of what's going on in the markets. And it kind of appears to me that there's some panic. I mean, we had this sudden end to the trade war. And, you know, whether I'm for or against it is immaterial. It really looked like we were winning because China had quite a bit of problems. And I know you're probably sick of hearing about trade war as much as I am, but there's some relevance here to where I'm going to go with this. So it looked like we were winning because China's starting to see a sizable increase in private sector debt defaults. That's a dollar liquidity issue. And how does China get dollars? Well, they get it through trade. So it looked pretty good, but all of a sudden out of nowhere, the deal's done, it's over, and there wasn't going to be a public document, and now apparently there's going to be a public document. It's not finalized. I mean, we've heard all these things before. And so why would we come to an abrupt end to the trade war? And I can only think of one reason, because remember, the whole trade war was based on the economic strength of the United States. Now, some people say, well, there's no way the government really keeps an eye on this closely, but maybe President Trump, maybe the Fed, maybe the power, his, not his board of directors. The term eludes me for the moment. But anyways, Trump's closest people, perhaps they are seeing something coming in the pipe in the data. And some of this that you see that doesn't make a lot of sense is there's normally a very strong relationship between Canadian unemployment or Canadian jobs and U.S. jobs. So when Canada posted a minus 71,000 jobs created last month, and we posted like 260 some thousand created, it doesn't make sense. Normally that relationship would imply that we lost 500,000 jobs, normally. Now, I'm not saying the BLS was cheating or not. I'm just saying normally that's what you see between the relationship because Canada posts before we do. And then if there were so many of these jobs created, why were unemployment claims all of a sudden, boop, boop, two weeks in a row above average? Why did that happen? Why did President Trump call the now former CEO of Boeing? Did he call him to say, hey, I've got some branding ideas for you so you can fix when you fix the 737 MAX? I got some ideas? No. Did he call him and say, hey, I can fast track this through FAA approval? No. I think the concern he had was, are you going to be sending people to the unemployment line? Because this weekend I saw that a steel manufacturer or producer in, I want to say Michigan, is sending home, I mean, they're the largest employer in their town, and they're sending like, I want to say 80%, over 1,000 people are headed home onto the unemployment line. And the reason isn't just collapsing steel prices, because remember, steel got tariffed. The company cited a weak demand from the automobile sector because that's who they supply. So if a steel, you go to the source, the mouth of the river, and you see, okay, steel companies laying people off because they're not building enough cars. What does that tell you about car sales? They're getting weaker. So I think there's some concern that the recent uptick in unemployment claims could be bad news. I mean, well, it is bad news, but maybe there's something deeper going on. I wrote last Friday about the Fed panicking. Why are they dumping so much liquidity in the market out of nowhere? You could look at the stock market, you could look at the bond market, and you could say there's no reason for this. Yet they're acting like it's 2009, and they're just going berserk with massive dollar loans that we were told, oh, they had to do with tax filing days that somehow mysteriously went for months. All they have to do with the year-end liquidity issues. Do the banks not know that there's a year-end coming? Why do they need, $300 billion in dollar loans? Because there's a dollar shortage. So it tells me that something doesn't add up. And we see that in the durable goods new orders today. We see that in the lending data. So let's go take a look at some of that lending data now, just as we're doing a backtrack from last week. And I think this is worth it because you look at real estate loans, and now the growth rate is down to 4.18%, which is over here on the left side. So you can see in blue, this is well below the trend of where it was during the last economic expansion. You can see that real estate lending, blue, was running over 5%, and it wasn't until the recession that started getting under a 5% growth rate. We barely saw over 5% just after 2016. So real estate lending has been weak and sitting right around 4%. The 6-month rate of change is validating that at 2%, and the 3-month rate of change is at 1.33 and falling. This on the back of what was all-time record low in interest rates right here. And we're seeing some uptick from this drop in interest rates, but not much. Not like, look at here. You could see going back to 2014 through almost 2017, those lower interest rates really drove the real estate market. So you look in the news and you're like, oh, look, new home sales are up and pending home sales. They're not up that much. They really aren't, because you're not seeing a big demand in loans. Commercial industrial loans, the growth rate is just continuing to fall. Now, this was revised higher. Now, some of this data does get revised higher, but it is down from last week at 2.8%. And again, it is worth noting that commercial industrial lending doesn't contract until roughly the middle or toward the end of a recession. And now this thing is fast tracking its way down. The 6-month rate of change is just hovering between zero, both sides of the fence, and the 3-month rate of change is somewhat sticky, just below zero. The last time we saw that was 2016 to 2017, and everybody missed the reflation boat, and now they're betting on reflation. This is not reflation. This is not reflation. This is not reflation. Here's your reflation. Is 2016, you have a near 5% growth in real estate loans, and it shoots up to probably somewhere around 7%. Here you have the great reflation is 4 or 3.75 to 4? No. Loans and leases, looking at the total pool, now you're going to see some drag on commercial industrial lending on the total pool of loans and leases. Again, this data here represents 1/3 of all loans in the marketplace, and it's flat at 4.75%. You can see, looking back all the way from 1990, that our current trend of lending growth rate, this last economic cycle, taking out the lows of 2016, we're below trend. We're sitting below 5%, and 5% was as weak as it got in many of the last expansions. Obviously it came out of the recession, but look, it did not get below 5% until the end. And here we've been stuck almost under 5% most of the time, except for this brief period here where it shot up going into 2016, and then it tapered down. And the 6-month rate of change is flat at 2. The 3-month rate of change is flat at 1. So it's telling us that the year-over-year growth rate is likely headed lower. So this notion that there's going to be this huge reflation in the economy, whoops, I did not actually mean to close that, but we'll bring it back up in the background while you can't see it. So this notion there's all this reflation going on, but there's no evidence of it. There's reflation in terms of people piling into stock prices because they said, hey, I missed that 2016 move, so I'm not going to miss it this time. So when you look at like the weekly data, why did I write about the 4-week moving average jobless claims 2 weeks ago? Why? Because it's a good indicator. In 2016, the 4-week moving average jobless claims was still falling. It's been plateaued now for over a year. So there's no reflation there. So what if you want to see reflation, what the 4-week moving average jobless claims data means is that people that lose a job are quickly finding another job. Now we're not seeing that. How about the weekly oil inventory data? What is it telling us? Well, but last week there was a crude draw. Yeah, great, because half of the imports were down. Half of that draw was due to a decline in imports. Big deal. What we have seen is 6 consecutive weeks of gasoline and distillate builds. Now, what do distillers think? Jet fuel, diesel fuel. Why would gasoline and diesel fuel and jet fuel be building if we're reflating? Because we're not. How about the Red Book same-store weekly sales? Remember, there's this big hoop to do about the Black Friday sales. And guess what? American consumers figured it out. Don't do your shopping on any day but Black Friday, and do it and do a lot of it. Well, that became, hey, look, Black Friday sales off the charts. It's just the beginning. No, it turned out it wasn't. Turned out American consumers, again, got smart. Why? Because the Red Book same-store weekly sales have been falling on a year-over-year basis and on a weekly basis. So the weekly data, the lending data, the same-store sales, the oil inventory data, it's not saying any sign of reflation anywhere. But yet people believe. They bet everything on it. They're hoping. Not sure they're going to be right, but you can be right for a while until you're wrong. So in terms of liquidity, the Nasdaq McClellan Summation Index is finally pushing out of its little consolidation range, trying to find liquidity in a market that is literally just rising on fear of missing out. Here's another thing I just popped into mind. Did you see FedEx's earnings? Now, they're on a fiscal year, so they report earnings differently. So what we see as a normal earnings season, they report early, but they're just on a different schedule. Why did that actually matter? And their stock isn't down just because the Amazon's cutting ties with them. They're down because global shipping is down. And FedEx has a long-standing relationship with the S&P 500. And I was one of the first people that came out and said, hey, wait a second. Time out. FedEx is telling us the S&P 500 needs to be down by more than 1,000 points from where it is now, based on its long-term historical relationship. ZeroHedge.com came out the following day and said, yeah, not based on anything they know about me, but they put a chart up and said, look, here's the relationship between the S&P 500 and FedEx. How do you have reflation when people are shipping less? Do people have 3D printers at home now and are just printing stuff out? No. So less shipping means there's going to be less retail sales, less stuff being moved through the pipeline, fewer new orders. Let's take a look at, instead of talking about the M2 money supply today, we'll do that Friday. Institutional money funds continue to see an inflow of money, which is typical going into recessions as people sell stocks and put their money in cash. And you say, well, wait a minute. How is it possible the stock market can go up if people are selling? Welcome to the magic world of indexing. When you understand market cap weighted indexes, where most of your money is going into just a few stocks out of the S&P 500 or NASDAQ 100, it is possible that a professional money manager who is not, say, selling their Apple shares, but selling other shares, can have large liquidations. And we've seen huge liquidations the last couple of months. But we're seeing only 8% of the S&P 500 make new highs. That's 32 stocks. Because when someone buys S&P 500, most of their money is going into the Apples and Microsoft. So you can actually see a rising market against liquidations. Seeing that. So anyways, this is important because, again, money flowing into institutional money funds tells us there are people selling. And we can zoom in and see that they've slowed their pace a little bit, but still money is flowing in there. Let's take a look at how hedge fund managers are positioned. Again, we got a lot to catch up on here. You know what? Let's talk about the economic data first. Let's do this first and we'll finish there. So this is today's durable goods new orders. So what I have, and the headline number is down a lot because of Boeing, and on a year-over-year basis is down, I want to say 5.7%. I want to focus more on the consumer. The consumer is 70% of the U.S. economy. Boeing is not. So this is new orders for consumer durable goods, excluding defense and excluding non-defense aircraft and parts. Again, I assume that most people watching this video do not own an airplane or are not buying parts for their airplane. And it was pretty easy to tell that the number was going to fall because out of all the regional Fed surveys, 2 of them put the new orders index, which is Philadelphia and New York. And you can see it's very volatile, but the trend in the red line is down, as is the trend in the blue. So even though we can zoom in a little bit today, you see there was a slight uptick in November to minus 0.45 from minus 1.55. Looking at the Fed surveys in December, they're telling us there's no major change here. Nothing to get excited about in terms of a change in durable goods. We can also look at the 4-week moving average initial claims against durable goods because, again, when do people go out and spend money on durable goods? Like, again, washers, dryers, refrigerators, things that last a long time. Well, when they can afford to. You could say, well, when they need to, yes, but people, look, if your washing machine breaks and it's old and you don't have the money, you're going to fix it. Or if you're like me and you just like to see if you can fix things and you somehow for $35 fix it, you feel pretty good about yourself. The other side is people will buy, man, sometimes people just want a new one. Maybe it's like, that thing's 10 years old and I never liked the color anyways, I'll go buy a new one. But when the 4-week average for initial jobless claims is plateauing, so you can see here, you see, well, wait a minute, this is shown inverted. So normally you see claims are falling. So the number of claims can falls, and then somewhere around 2018 it starts to plateau. So people are not finding jobs as fast now. This is telling you the economy is slowing down. And this happens late cycle, except for back in the dot-com bubble where it kind of fell off a cliff. So if people aren't working as much, well, it makes perfect sense. Look at when durable goods new orders fell. Pretty much right after calendar year 2018 hit, and you see at the same time, 4-week moving average initial claims start to plateau. People don't have the money to spend, so they're not buying those goods. So when they don't buy those goods, guess what? Fewer jobs are created, and some people lose their jobs. And you can say, well, but maybe there is reflation. All right, well, here is your big evidence there is no reflation. If you look at the average weekly hours of production and non-supervisory employees in red, starting in 2018, it's gone down. They were working nearly, this is not the all-time record, but this is high. They were working over 42 hours, almost 42 and a half hours a week. That's a lot, historically, a lot. And look what happened when their wages went down. I'm sorry, not their wages did go down because their hours per week worked dropped by 1 hour per week. So, well, that's not that much. You say, well, it's time and a half. If you're making $20 an hour, that's $30 an hour a week. And at the end of the month, that's $120. That could easily make a payment on your new washer and dryer, I would imagine, or some other durable good. And so you can see durable goods new orders have fallen right along there. Smaller paychecks, less spending. All right, let's go and look at how hedge funds are positioned. So we can see that they've increased their short position on 10-year treasuries, and they're running into wall here at 1.9%. They just can't seem to break this. They're trying to, but again, speculators cannot move the market all on their own. There has to be some lending demand, and as you can see, there's not. There isn't lending demand. There isn't an increase in hours worked. There isn't some magic job just showing up and putting people to work. And here we look at 30-year Treasury bonds, nearly the second shortest position. Well, it is the second shortest position in history if we look at the last 2 weeks. And I want to show you this other chart. It was posted on zerohedge.com. The aggregate Treasury futures net speculative position, there it is, second largest short position in history. So when someone says interest rates are going to go higher, you've got the second biggest bet in history that interest rates are going higher across all Treasury futures, and they're not. They're running into a wall. Now remember, when this unwound just barely up to here, what happened? There was a big drop in interest rates. We'll look at that. So they added those shorts back. They didn't get the big push, and there's still a lot to unwind here. There's still a lot. You want to see interest rates get to zero? Watch this whole thing. Eventually, this will unwind. And they didn't show interest rates on here. But when this thing unwinds, interest rates go down. Big time. Let's look at oil. Hedge funds are massively long oil again. They're getting back to near their record long positions in oil. It's hard for me to understand why someone would take a speculative position on oil when you have far more crude inventory builds than draws, and the draws are very small and the builds tend to be much larger. But they're betting on some massive reflation here, and these bets in oil are also pushing interest rates up a bit. There is a relationship between crude oil and interest rates. So S&P 500 hedge funds remain net short. Kind of odd. You'd think they'd be chasing this higher. And gold, they're very, very long gold. So they believe there's some massive inflation coming from all this Fed money printing. And what did we see this last week? Core PCE, which is the Fed's preferred gauge for inflation, fell to 1.6% on a year-over-year basis. That's not inflationary. Not at all. I need to fix my charts because the Fed has decided to no longer produce one of their charts on the monetary base. So I need to fix that. At some point, we'll look at the relationship between the monetary base and gold, and you'll see something very interesting. So hedge funds have backed off their NASDAQ speculative long positions as it's gone up and are going crazy in small caps, which is mostly U.S. companies. As far as the dollar index, they're backing off at a point when really the dollar should be rising. And maybe if I remember, we'll take a look. But dollar should be rising here because of the Fed contracted world dollar liquidity. So there's a shortage of dollars. So you'd think the hedge funds would be on the right side of this. But a weaker dollar does also kind of create some inflationary notes to it and leads to higher interest rates. So the fact that hedge funds are backing off this position and the dollar has weakened a bit, it does hurt interest rates a little bit, but the general trend for the dollar should be higher. So looking at net short in volatility, we see hedge funds are backing off their net short slightly, but there's still a long ways to go to unwind these positions. And usually you don't see a market bottom of some kind until the hedge fund managers are long. So again, let's go back here and focus on this chart, and we will switch over to the S&P 500. We haven't really looked at this much from a long-range perspective, but the intent is the 200-day moving average. And right now, people are insanely bullish about the market. And normally, when stocks prices get well over their 200-day moving average, like you see here, and you can see back down in here, there's what's called mean reversion, where they go back down to the 200-day and sometimes below. So what you're seeing now is one of the largest disconnects between the S&P 500 and its 200-day moving average, meaning at some point it is going to fall and reconnect with that somewhere around the 3,000 point mark. We will see when that day comes, but for today, it does not. So 10-year Treasury yields, despite this massive short position in the Treasury market, is still sitting right around 1.9%. Can't seem to break through here. Looking at 30-year yields sitting right under support at 3.78%. So still can't break through this at all. No sign of its ability to do that. But again, remember, there is this massive speculative short position across all Treasury futures, all duration, from short to long. So people are betting on higher interest rates. And again, all they've gotten is right under here. So if we look back, the last time hedge fund managers drove interest rates up, they went to speculative position higher. And then when that unwind happened, now that remember, this unwind here was really, really small. Let me go show you. It's really small. So this was that long position that drove interest rates up, or that short position drove interest rates up. This here took 30-year yields from that high back to all-time lows. What's going to happen when this thing completely unwinds? What is going to shock the markets that does that? I don't know. But that's how you're going to see interest rates back at zero. So the fact is, right now, we're seeing 30-year Treasury yields knocking on 2.376%-ish, not breaking through there, and more likely to head down than up. And if we take a look at TLT, 20-plus year Treasury yields, we see, again, just heavy selling by European investors who think Brexit is going to be inflationary. I've got news for them. It won't be. But anyways, they'll try. And so they've been selling. And how do you know that? Because you can look at the intraday overnight, and you can see what's happening is Asian investors come out first. They tend to be buying. And then you see European investors tend to sell, and that's in the light shaded areas. But anyways, we're looking like we have another bottom here. Volume is thinning down. Sellers are getting weaker. We're seeing late day buying. U.S. investors are definitely buying. So you can see here, European investors kind of ending their day somewhere in here, and American investors coming in and buying. So at some point, all that supply will be soaked up, and those speculative short positions will get unwound, and interest rates will go higher. What kind of surprises me is we have the trade deal allegedly done. People are selling ag commodities. Maybe they don't think there's a trade deal. I don't know. Perhaps they think the trade deal is really great for Apple stock. Again, this is market cap weighting at its finest. Clearly, there's no way this trade deal is going to lead to some boom in the sale of cell phones, but you wouldn't know it by looking at Apple stock at all. Take a look at the dollar. Let's zoom back out on the dollar, and it has reclaimed its 200-day moving average after being dumped below. So, again, the dollar, despite hedge fund managers trying to get out of their dollar long positions, when you're in, think about it, when you're in a period where there's fewer dollars, right? So the Fed has contracted world dollar liquidity. What does that mean for those who have dollars? The implied value of them goes up, right? Someone who has a debt that needs to be paid, a dollar-based debt, hey, I need dollars. And someone who has dollars, well, that means the person who needs them is going to essentially trade or pay more money to the person who has dollars to get them. That's why you see during periods of dollar liquidity problems, a rising dollar. The other thing you can notice is there's a strong relationship between durable goods, new orders, and the dollar the dollar should strengthen as new orders fall. And why would that be? Because how many people go down and pay cash for a durable good? Not many. They're typically financed. And when you finance something, you create dollars into the economy. Well, people aren't buying those goods. They're not creating dollars. The value of the dollar goes higher. So anyways, we've gone long enough. We will be back on Friday. There's going to be a little bit of economic data come out tomorrow. I'll put that up on Facebook. And on Thursday, there's going to be a whole bunch as we catch up to the oil data that's normally out on Wednesday and the initial jobless claims, which I'm really curious to see if that continues to tick higher, because it's telling us it should be. And at some point, poof, that whole boat starts to fall apart. So from my family to yours, I want to wish you a very Merry Christmas. And of course, I'll wish you a Happy New Year when we get there. The content of this video provides educational information only. It's not intended to provide investment or other advice. Materials not to be construed as recognition or solicitation by or selling securities, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre in my own personal capacity. Opinions expressed in the video and that amount do not reflect the Atlas Financial Advising or Steven Van Metre Financial.